what's going to happen in Asian markets, or what's happening now and what's going to happen going forward, there's 5 things here. One is obviously the trade war. And it says trade war in the presentation, but there's actually multiple trade wars going on. I should add an S in there. So obviously there's the big one, which is China and the US. But for those of you who follow the news closely, there is some trade tension between Korea and Japan now. And obviously there's tension between the US and Mexico, and also between the US and Europe. So when you add this all up globally, there's a lot of trade tension, and it is impacting markets, including Asian markets. The second thing, which is a subset of the trade war, but is slightly different, is the Huawei situation. The third is what happens with US rates and the implications for flows into emerging markets. As many of you know, Asia is about 75% of emerging markets, of MSCI emerging markets. So the majority of flows into Asia actually come via emerging markets, not Asian earmarked fund flows. And then fourthly is Hong Kong protests. And lastly is a lot of the elections that have either taken place or are taking place going forward. So the first is the trade war. You may recognize this slide. It's actually been in our slide pack for like a year and a half now. And for a long time, we had these three scenarios. One was tit for tat escalation, which is what happened in 2018. The second was negotiated outcome, which looked like what was going to happen this year. And then the third was extreme retaliation. Now, actually, my base case is none of these three. It's sort of a prolonged standoff between the two countries. And the thing that may break this standoff could be the US presidential election, because as we get closer to that, Donald Trump will need some sort of win. Obviously, trade with China was one of his big election promises previously, and if it's still in standoff, that obviously doesn't bode well for re-election. But right now, we appear to be in a standoff. And as you can tell, the market is getting increasingly tired of this prolonged standoff. So after the G20 in Buenos Aires last year, and they came to a sort of truce, there was a nice pop in the market, if you remember, and then there was another strong rally in January. And this year, after the G20 in Osaka, markets went up for 1 day. Some markets went up for 2 days, and then that's it. So investors, including myself, we're not positioned for a resolution to the trade war. Most investors that I know are not positioned for a sharp deterioration in the trade war. It's just kind of treading water until either side caves. And my guess is that that's going to be closer to the US election. So I can take more questions on that in the Q&A. I'm sure there's a lot. Okay, the second thing is Huawei. So this is related to the trade war, as I said, but not exactly the same. So as you know, Huawei has been put on the entity list in the US, which for a while prior to Osaka meant that US companies couldn't trade with Huawei or use their inputs. After Osaka, that's been loosened a little bit. But some of you know we do have a whole presentation that me and my team have worked on called the Technology Arms Race, or the Technology Cold War, and the premise of this presentation is that the trade war is not actually about trade. The trade war is a subset of issues that has arisen and are going to continue to arise with respect to the hegemonic decline of America and the rise of China. And Huawei is another one of those issues. And America is, what this slide shows, we went through and looked at every area of tech and who's ahead, China or the US, and who's gaining, China or the US. And most people are very shocked when they see this slide, because they're like, oh my goodness, China is way further ahead than we thought they were. And actually they're gaining in a lot of the things where we didn't even know that, they had these capabilities. So this Huawei situation, while the specifics may be worked out as part of the trade war, I think this aspect of the technology Cold War is going to continue. So how are we positioned right now? We don't own anything in the tech supply chain other than TSMC, which is obviously a huge company, has many customers, including Huawei. So it's not that sensitive. But those stocks are actually trading quite in a volatile manner right now, because every time there's a headline on Huawei, they can go up or down 10%. So we are just out of the supply chain because there's not enough visibility. On the flip side, some people think, oh, technology Cold War, this is too scary, I don't want to be in China. But I actually take the complete opposite view. Maybe I'm biased, but I take the complete opposite view. And it's, if China is the technology power that's rising like this, and America is the power that's been on top since Britain, I know which team I'd want to bet on. So when we own stocks like Tencent or Alibaba or Baidu, these are the winners. These are the horses that China is putting its bet on in the technology Cold War. And I think that these companies are going to continue to thrive in the environment. So we have very big positions in both Tencent and Alibaba. We don't hold Baidu at the current time. Okay, and then Asian markets and EM, as everybody knows, the Fed has gone pretty dovish, but a lot of other central banks have gone dovish at the same time. So the impact of the US dollar to date has not been a huge fall off in the US dollar. Our medium-term view is that the US dollar should weaken, and as you can see from the chart on the left, this is generally very good for flows into emerging markets. I guess the second thing is that those of you who have followed EAI for years now know that the main point of this fund is that it provides access to growth. We are a growth fund. Every stock in the portfolio is a growth stock. And emerging markets still has very, very strong growth. So the average EPS growth in our portfolio is around 17%, 17, 18%. So when you look at what's happening in the rest of the world and why these other central banks are getting so dovish, it's because there's no growth at all and there's no inflation. So to have a portfolio that is still growing at 17, 18% in countries that are still growing between 5 and 7%, this, in my opinion, is going to become more scarce. And as that scarcity value of growth improves in the world, I think valuations in some of the less expensive emerging markets will start to catch up to developed markets. So that's what the chart on the right-hand side is. You can see those yellow diamonds are the growth, and you can see that Asia's growth compared to its PE is just totally out of whack with the rest of the world, particularly Australia. Okay, democracy in Asia, there's been some big elections. India was probably the most important one for our portfolio. So Modi, as I'm sure you know, has a very decisive victory. I actually just got back from India last week. And he has a very strong mandate to continue the structural reform that was started in the first term. So that's a long-term positive for India. Obviously, India was one of the best performing markets in the world since 2014 when Modi was elected the first time. There's also been elections in Thailand, which was a bit of a debacle for those of you that follow the Asian news. It took them about 2 months to figure out who'd actually won. And then the guy who is the military leader who's been there since the coup is actually now in power. So Thailand, we don't have any positions in Thailand. It's expensive and I don't really like the macro environment. In Indonesia, as expected, Jokowi was returned for a second term. We actually do have quite a few stocks in Indonesia right now, more than we usually do. We own both Bank Rakyat and Bank Mandiri. So part of the reason is, in conjunction with the EM chart that I showed last year. Last year, when people were thinking that rates were going up in the US, this is very bad for current account deficit countries in emerging markets. And the big current account deficit country in Asia is Indonesia. So Indonesia did very poorly, and they had to increase rates. I think it was 3 times. It was by 75 basis points over a very short period of time to defend the currency. But now that US rates are going down, that whole thing is reversing. Indonesia is expected to cut 75 basis points this year. And that's a strong positive for the market and for the bank. So that's why we have Indonesia right now, whereas typically we're underweight ASEAN. And then I'll just say 2 words on the Hong Kong protests. Frankly speaking, this doesn't impact our portfolio or anybody's portfolio very specifically. So we are underweight Hong Kong and slightly overweight China, so underweight Hong Kong, China as a group. But on the day when the biggest part of the protests happened, the Hong Kong market did underperform quite significantly. That said, it's not a positioning because of the protests, but it's just something to think about for an Asian portfolio manager is what is Hong Kong going to look like between now and 2047? Because 2047 is when Hong Kong goes back to China. And these protests are actually a little bit alarming because of the size. Depending on who you listen to, there's been over 1 million people at a number of these. The fact that Carrie Lam, who's the chief executive of Hong Kong, got the policy environment so wrong. And the fact that Beijing is obviously not happy with Carrie Lam because this was all happening at the same time as the trade war and going into Osaka. And it just highlighted, it was not a position that Beijing wanted to be in. From a portfolio perspective, I did also just get back from Singapore. And there are a lot of people in Singapore who think that Singapore is going to be a beneficiary of this because corporate headquarters are saying, do I really want to be in Hong Kong or should I just move to Singapore? It's easier. Some of the Singaporean banks are saying we are looking forward to all the funds flows that are going to come out of Hong Kong into the Singapore private wealth management business because people are worried about what's going to happen. So it's just, as I said, it's not anything that impacts our portfolio on a day-to-day basis, but it's something to keep an eye on going forward. The thing to keep an eye on in the long-term basis is whether pro-democracy and shows of democracy in Hong Kong infiltrate into China, because that's obviously what Beijing is really worried about, not necessarily what happens in Hong Kong. This is just a quick update on positioning. So as you know, we have 3 core sectors: financials, consumer, and technology. Right now, financials continues to be the biggest part of the pie. Consumer is a sector we continue to like. A lot of that is Wuliangye, which is a stock in China in A shares, which has done very well for us. It's up over 100% since we bought it. And then technology is a bit of a smaller slice of the pie right now because, as I mentioned before, we don't own anything in supply chain. That's primarily the mega cap tech companies and internet. So we're staying more on the consumer side of technology than on the hardware side. And in terms of country allocation, so China, Hong Kong is the biggest part. It's the biggest part of the index, though, so that's a slight overweight altogether. India's around 15%. And that's, as you know, we're always overweight India, very bullish on the long term. And then Korea and Taiwan continue to be very small weights. The only stocks we own there are Samsung and TSMC. In terms of top 10, still very concentrated, around 53% of the portfolio is in the top 10. You can see the biggies at the top, Tencent, Samsung, TSMC, are all in the top 10. Hong Kong Exchange is a company that I really like because as flows go into China via the Connect and by a number of other initiatives that they have, Hong Kong Exchange is a monopoly position and it just sits there and clips a ticket on everything that goes in and out of China. So we really like that on a long-term basis. And then Bank Rakyat is probably the only new entrant into the top 10 list. That's the Indonesian bank that I mentioned before. So here's an update on performance. So performance has actually improved quite significantly since the beginning of this fund. So on a one-year basis, we have about 2.2% of alpha for over 4% on a 6-month basis. So that's calendar year to date is around 4% alpha. And yeah, we're just working to get those since inception numbers back up to even. But performance is, yeah, it's improved a lot, and I'm happy with these numbers calendar year to date. In terms of the stock price, not so happy with the performance of the stock price. It is at 96 cents, and as you know, we did the option expiry at $1. So that's about a 14% discount, and that's a bigger discount than we would like. So we're looking at our options, and we do have a buyback in place, just trying to make sure that discount closes over time.